Welcome back, and in your top business story, Abu Dhabi's inflation stood at 0.9% in Q1 2012, according to the Abu Dhabi Statistics Centre's periodic report on the Consumer Price Index, and the inflation rate in the Emirates of Abu Dhabi for the month of March and the first quarter of 2012. Average consumer prices edged up 0.9% in Q1 2012 compared with Q1 in 2011. The single largest rise was seen in the prices of food and non-alcoholic beverages, which accounted for 84.4% of the rise in the index. The largest price increase was in the meat subgroup, which advanced by 12.1%, followed by fish and seafood up by 10.7%. Coffee, tea and cocoa up 10.0%, oils and fats up 6.3%, and bread and cereals up by 4.3%. The next largest contributor to the overall rise in consumer prices over the first quarter of 2012 was the restaurants and hotels group, which accounted for 40% of the increase in the CPI. The Board of Directors of UAE Central Bank held its fourth meeting for the year 2012 in Abu Dhabi under the chairmanship of Khalil Mohammed Sharif Olathi, which is the chairman of the board. The board reviewed the central bank's audited annual accounts for the fiscal year of 2011 and distribution of net profits, which amounted to 3.7 billion dirhams. It initially approved 55% to be transferred to the Ministry of Finance, 20% to the Sheikh Zayed Housing Program, and 25% to be transferred to the account of the permanent deposit of the federal government at the central bank. The final decision, however, is to be made after the feedback from the State Audit Bureau. The UAE 2011 fiscal surplus was put at 71.5 billion dirhams in 2011 off the back of a rise in oil prices. And according to a local paper, the Institute of International Finance in Washington revealed that a rise of 50% in oil prices resulted in a rebound in the UAE economy in 2011, accounting for 5.3% of GDP. This increase boosted the UAE's total revenue to 443.5 billion for the year, up from 315.1 billion in 2010. While oil export earnings shot up to 350.5 billion dirhams from 239.3 billion dirhams. As for this year, the report showed that the UAE would see a surplus of around 35.5 billion dirhams, while expenditure is set to rise to 381.4 billion dirhams. And let's now take a closer look at the stock indices across the GCC. And looking to other news now, the Federal Reserve stated that the American economy continues to expand through growth within manufacturing, hiring, and retail sales. This was seen at a modest to moderate pace from mid-February to late March, which boosted the overall European stocks. So will this trend continue into the next quarter? And what other factors might further boost European stocks? Well, we earlier spoke with Bruce Powers, the head of research at Trust Securities.
We've seen a bit of a correction over the past few weeks in European equities, largely driven by additional concerns about the European debt crisis. Stocks hit a low the other day and have since been bouncing. I think we can see a continuation of this rally back into downside selling resistance over the next 1 to 3 weeks. But after that, I would expect the markets in Europe to turn back down again, and I think we could end the quarter lower. After last year's sell-off on global equities, we saw a much stronger recovery in the U.S. market, largely driven by improvements in the economy. Those improvements have helped European stocks up to date, but they're also being weighed down by the evolving European debt crisis. In the first quarter, I think we can continue to see a modest improvement in the U.S. economy, which could help a little bit the European stocks. But at the same time, again, we have this debt problem weighing on the market. We also have the potential for surprises. Major U.S. banks, for example, are expected to report losses in the first quarter. They could surprise to the downside. In Europe, we're going to keep a close eye on European banks and how their earnings come out. I would expect them to be a little more positive because the European Central Bank, starting in December, gave out over 1.2 trillion euros of short-term, 3-year, 1% loans to the banks, and that should certainly help support their earnings. If there's any surprises to the downside in the bank earnings, that's going to weigh on the stock market performance.